Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 26, 2025. Hey, I hope you're doing well. I hope you're having a nice weekend. Hope you had a good trading week last week, and I really appreciate you coming to my weekend review. I hope it is going to be helpful for you. I think I've got some good things in store today. So, the format for today's podcast is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the open and closed positions and all the trades that I made last week. We're going to talk about when I entered, why I entered, what the setup was, what the strategies was, what the confluences of signals were, and how I set up the trade, how I position size, how I place my two stops, my emergency stop and my end of bar stop, how I place my trailing stop level, how I take partial profits if the market moves in my favor, and then ultimately how I exit the position in full. So we'll take a look at all the open positions, all the closed positions, and we will see how they are doing. And then we're going to talk about how I'm going to manage them going forward. So it was a good trading week. I had some really nice trades. I exited some positions that I've been in for quite a while at some nice levels. And so hopefully this is going to be helpful for you and valuable for you, and to get an idea of how I look at trading, how I look at the setups and why I enter and what I do with them after I enter. And if you do find it helpful today or of value, I really would appreciate if you could hit the thumbs up button or subscribe. It really helps out with YouTube and lets YouTube know that there's some valuable content here. So after we go through the current trades, I'm going to talk a little bit about trader psychology. Most important skill, everybody, it's very simple. Create a plan and then follow that plan. Most people create pretty good plans. It's in the heat of the moment where they have these impulsive behaviors and get out. But I'm telling you, from over 30 years of experience, if you can create a decent plan, doesn't have to be the best plan in the world, but if you can create a decent trading strategy and then just simply follow it, you'll be way ahead of most traders. And so you learn some strategies, whether you learn them from me or from someone else, it doesn't matter. First, learn them, and then second, follow them. After that, I have gone down through my master watch list. I do that every Saturday night, and I go down through all of the markets that I follow, and I have identified some potential trades for next week, both on the daily time frames and the weekly time frames, that are getting kind of close to potentially triggering. They're not there yet. If they were already there, I probably would have already taken the trade, but they're getting close. And so, if you listen to this podcast on a regular basis, you'll see that I go through this watch list. I look for key levels, confluences for the coming week, and I highlight those if they're kind of close. And then next week, if they get there, then I have the option and I'll consider taking the trade. So I've heard back from a lot of you that that's been really helpful for you to kind of get an idea of my process. And so I'm really glad to hear that is helping. But I've got some good potentials for next week, and both on the daily and the weekly time frame. So I'll go over those in detail when we get to that portion. So let's go ahead and run this U.S. legal disclaimer, get that out of the way, and then we'll get rolling. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding through that with me. Here is the first open position that I have. It's MasterCard. On this particular chart, I'm going to go through a little bit more detail about how I set everything up, but then as I go through additional trades that I'm in, I won't be as precise. So I'll put a little extra time into this one. So this is MasterCard, MA. I entered MasterCard back here on the 20th of June. So first question. Why did I enter it? I really prefer to take entries that have a confluence of signals. This particular entry that I bought at 532.95 on the 20th of June was a confluence of two deep dip buy signals. That's the deep dip buy stock trading strategy that I developed and used. So on the particular day that I entered this, the confluence was during the day we went under the 200-day moving average, which is the black line, but yet we closed back above it. That by itself is a legitimate entry signal. But we also had an additional entry signal, and if we look down here at the RSI, during the day we went under the 30 RSI, and then we closed over the 30 RSI. Either one, intraday rejection of the 30 RSI by itself, valid. Intraday rejection of the 200-day moving average, valid. But both of them happening together, much better. All right, and so that is why I took the trade. So now, when I take the trade, of course, the decision you have to make is how many shares do I have to buy? So I have a very simple formula. I've used this for years. This is what I teach in my lessons, but it takes into account two different inputs. The first input is how much money do you have in your account. The second input is what is the value of the 2 ATR. Right now it's $16.35. So what I do is I take 1% of my total capital. So if my total capital is $100,000, 1% of that is $1,000. And I simply divide that by the value of the 2 ATR. The value of the 2 ATR right now is $16.35. So I just divide that by $16.35. It simply tells me to buy 61.16 shares. So I would just round that down to 61 shares. So based upon the account value that I have and the market volatility, the 2 ATR factors in the market volatility, it tells me to buy 61 shares. Okay, so I go ahead, I buy 61 shares. My next step is I take my entry price minus that 2 ATR and I put my emergency stop down here. So if I have 61 shares and it moves down 16.35, how much have I lost? I've lost 1% of my capital, right? Because we just did the math. So you always have to have your worst case scenario. And just to simply say, okay, if I lose 1% on my account, that's it. It's over. It's done. That's exactly what we're doing with the emergency stop. Now, the good news is that this emergency stop only hits about 5% of the time. The other 95% of the time, if I have a loss, it will be because of my end of bar stop. Emergency stop 2 ATRs below, end of bar stop on this particular trade is really the opposite of why did I take the trade. I took the trade because it rejected the 200-day moving average on a closing basis. Therefore, in the future, if it closes under the 200, even by 1 penny, I'm out for a small loss. Okay, so 5% of the time, yes, you'll hit your emergency stop. The other 95% of the time, I'm going to lose much less than 1%. So if the next day it just closed below the 200 a little bit, I just lose a little. If it closed here halfway, I'd lose 0.5%, right? But it's important to always have a good risk to reward ratio. It's important to enter your trade about as close as you can to your stop. So if you're wrong, you can be wrong small, but if you're wrong, you can have a nice big trade like this. Okay, next step, after I identify the entry, I position size, I know I placed my emergency stop, I know where my end of bar stop is. Next thing I do is I take my entry price, then I look at the value of the 1.5 ATR. Right now it's 12.26. I simply take my entry price plus 12.26, and I put this orange line up here. This is my trailing stop level. And all I'm waiting for is if it moves my way, if it gets to or above the trailing stop level, now I am in trailing stop mode. And all that means Doesn't mean I do anything if I'm in trailing stop mode. All it means that now in the future, if I have a close below a previous bar's low, I'm going to get out of half. And all this does is tighten. If you get out of half of your position, it tightens everything up. It moves all your stops up because now you only have half position, because I don't want to get to 1.5 ATRs and then just have it come all the way back down. So that's why I implement that rule. And sometimes it just goes straight up. So you don't have to get out of half of anything, right? But in this particular case, got to trailing stop level, and then we had a close below a previous bar's low. I got out of half. But I'll go through each bar in a minute. So now, everything we've talked about so far, position sizing based upon volatility, emergency stop, end of bar stop, going into trailing stop mode, these are all defensive moves where I'm taking action if the price moves against me. But I also want to take action if the price moves my way. I also want to be offensive. The stops and trailing stop, all that is defensive. Taking partial profits when the market gives them to me is offensive. And the way that I do that really is very, very simple. You know, the thing about trading is that the more simple you keep it, the better. I take partial profits if on the next day the move in this particular market moves the value of 0.45, and I set 3 profit targets each day. So let me show you, since I'm in this trade, let me show you exactly what I mean with MasterCard. So I take the closing price, 568.22. So I just take the closing price. This is for Monday, 568.22. Then I look for the value of the 0.45 ATRs. That right now is 368. So I take the closing price plus 368. My first profit target for Monday is 571.90. And the question you might have is, how much profit do you take? It's very simple. 10% of however many shares I have going into that day. If I have 50 shares, I'm going to take 5 shares off at 571 and 571.90. And again, what's 571.90? It's just the closing price plus the value of the 0.45 ATRs. Now, I do this 3 times. This is my first profit target. So I just take my first profit target, add the 0.45 to it again. My second profit target for Monday is 575.58. If it gets there, I'll take another 10% of however many shares I went into the day, and I do it one more time. I take the second plus 3.68. Third profit target for the day, 579.26. So it's that simple. And of course it changes every day because it's based upon the closing price. If Monday it goes down, then obviously I'm not going to hit any profit targets. And then I do the same thing. If Monday's price is lower, then I just take the lower price, add this to the upside, right? If you just keep going up and up and up, then yeah, you're just going to hit more and more and more profit targets. If you go down and down, down, unfortunately, you're not going to hit any profit targets that day, right? So, okay, so that's so the setup, offensive and defense. So let's just do it one more time. Why did I enter the trade? Intraday rejection of the 200-day moving average on a closing basis, intraday rejection of the 30 RSI on a closing basis. I enter, I position size, as I just mentioned. I place my emergency stop 2 ATRs below. My end of bar stop is closed below the 200-day moving average. I place my 1.5 ATR trailing stop level above. And again, if it moves up 0.45 ATRs from the previous bar's close, I take partial profits. Next day, up nicely. I hit 2 profit targets right off the bat. Next day, right up big, I hit 3 profit targets, I believe, on this particular day. So I'm taking off shares as the market's giving to me. In addition, here on the 24th, I got 2 trailing stop level. I actually got above it. So now I'm in trailing stop mode. So all that means is now in the future, if I have a close below a previous bar's low, I will get out of half of the remaining shares that I have at that moment. The next day it happened. We have our first close below a previous bar's low. After reaching trailing stop level, I took off the half of the remaining shares that I have for a gain of 3.07%. Okay, and we continue with the trade. Hit some profit targets here, hit some profit targets here, hit some profit targets here, then we move sideways, and then down, and then we consolidated, no profit targets, no profit targets. I did hit one profit target on Thursday there, and I did hit one profit target on Friday here. Okay, so earnings looks like it's coming up here on the 31st of July, so I never hold through earnings, so I will exit this trade regardless of where it is, whether it's higher or lower, just as long as it's above the 200, I will exit this trade before earnings. And so the remaining shares that I have on MA here, doing quite great, up 6.25%. But again, this is a deep dip buy, confluence of a deep dip buy, an intraday rejection of the 30 RSI and an intraday rejection of the 200-day moving average. McDonald's. All right. Well, I did grab McDonald's almost perfectly, thankfully. Doesn't always happen, but it did on this particular trade. Bought McDonald's, excuse me, bought McDonald's on the 26th of June here. Also a deep dip buy. The intraday rejection of the 300-day moving average. This is the orange line. So in the deep dip buy strategy, I use three moving averages. The black line, which is 200, the purple line, which is 250, the orange line, which is the 300. Those are the three key moving averages that I base these trades off of. On this particular day, on the 26th, it was below the 300. During the day, it was strong enough to close back above. That's my entry. That is my end of bar stop. So I entered here 285.63. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-day moving average. You see how close that is? If it would have just closed 1 penny the next day, I'd just be out for a very minimal loss, right? I know my worst case scenario was 1%, but that doesn't happen very often, 5% of the time. So I enter, I place my trailing stop level 1.5 ATRs above. Next day, took right on off, hit multiple profit targets. Next day up again, got to trailing stop level, trailing stop mode. Next day up again. So really nice, just right from that entry signal, took off, hit multiple profit targets. I'm in trailing stop level, 3 days of nothingness, and then here we have our first close below a previous bar's low after reaching trailing stop level. I took off half of the remaining shares I had for a gain of 2.12%. Then we had a few days up. I didn't hit a profit target here, but I did hit one here. I did hit one there. So I'm continually reducing my position size. And then we just kind of have moved sideways here for a couple weeks. And then here on Friday, I did hit one profit target here as well. So I'm staying in this trade until one of two things happen. One, if we close below the 300-day moving average, actually, that's my end of our stop. I have to get out. Or if we continue up, then when we get to a 65 RSI level, I have another rule that comes into play. Or if we reject the 70 RSI, I have another rule, and that would completely get out, would get me completely out of the trade. I have a lot of rules. I've been trading for over 30 years. Every single rule I have and that I teach is there for a reason. It's there to make you more money or to save you more money. And, I do teach private lessons. I teach a 20-hour course. I've taught people from all over the world, from beginners all the way up to the hedge fund level and everywhere in between. If you would like to study with me for 20 hours, I'll teach you everything I know. I'll teach you all the strategies that I use. We'll do lots of practice, lots of simulations, and I would love to have you a student, really. I would love to have you as a student, and my email is in the link of this YouTube video. So if you're interested, please reach out to me and we can get the conversation started. But I will teach you some really good things. So the remaining shares that I have now on McDonald's, up 4.24%. So really nice trade there. Bitcoin. Well, I shouldn't say Bitcoin. BITO. It is Bitcoin, but it's an ETF. So this is a different strategy. The last two that I talked to you about were deep dip buys. This is an abandoned baby. And you've probably heard me talk about this. Again, this is what I teach in my lessons. But A abandoned baby happens when the following occurs. We have a gap up. From the previous close to the open, we have a big gap up. Why? Well, for whatever reason, there was good news. The sentiment was extremely bullish. But we went from gapping up to the very next day gapping down. So we went from super bullish sentiment to bearish sentiment very quickly. And when this happens, usually in the future, you will see prices lower. If you have a gap down and then a gap up, that's bullish. And usually in the future, you'll see prices higher. I mean, look at here. We gap down and then we gap up. That's bullish. We should see higher prices. Did we see higher prices? We did. Well, this is the opposite. We gap up, then we gap down. Usually in the future, you will see lower prices. So as soon as this bearish abandoned baby occurred, I could have shorted here, but usually what I see is when these occur, you have an initial check back, an initial rally, and I keep this trade off the bottom of this abandoned baby. If it rejected the bottom, that's my entry, and that's what it did here on this day here. It went above the abandoned baby's low and then closed below. I took the trade at 22.87. Now with these particular trades, and this is the only strategy that I do this with this particular strategy, I set a very simple entry, exit, stop loss, and profit levels. I put my 2 ATR stop, like I do in every trade, above, but yet for my profit target, because I'm short, I put a 4 ATR profit target to the downside. So I'm risking 2 ATRs to make 4 ATRs. So if I'm right, I'm going to make twice as much as if I lose. But the nice thing about these abandoned babies is when they trigger, their win rate is higher than 50%. So theoretically, I should make twice as much than I lose more times than I lose. So I should make 4 ATRs more times than I should lose 2 ATRs. It's pretty good, right? Doesn't always happen, of course, but in my experience, these abandoned babies have been very good to me. So I'm not taking profits. I'm not going into trailing stop mode. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs. Now, how long is it going to take? I don't know. But can I say for certainty that either this is going to hit, the stop's going to hit, or the profit target's going to hit sometime in the future? 100%. Eventually it will get there, right? But all I care about is that I have a good risk-to-reward ratio where if I'm right, I make 2 times what I lose. And based upon the setup, the edge will be to the downside from here. So this particular trade, doing pretty good to the short side, up 1.96% so far. All right, Netflix. I entered Netflix on Friday. I entered Netflix yesterday here at $1,180.33 per share. Why did I enter here? Well, if you see this green box here, this green box is called a bullish order block. And I use these all the time for my swing trades, for my day trades. I teach these in my one-on-one lessons. They're extremely powerful. But what is a order block, a bullish order block? Well, a bullish order block, what you need to happen is this. You need a swing low. Look back here. You need a swing low followed by a swing high. And then you need another swing low that's lower than the first swing low. And then you need to break above the first swing high. That changes the market structure to the upside. And so we changed market structure here. It did go up, had a pullback, but you can see the change in market structure did move us up. So as soon as you break market structure, you have the swing low, swing high, swing low, break market structure. Now you can define what the order block is. The order block is the range of the order block is the high and the low of the lowest bar close before market structure change. So you can see I've drawn the green box, the high and the low out into the future. So with order blocks, when you change market structure to the upside, I like to buy when it comes back into the order block after it's formed. And you can see right here, had you bought when it came back into the green box, you would have done just great. So now we are back in the order block. And just because I'm in the order block doesn't mean that I'm going to enter the trade. I need one of three things to happen. I need a rejection of the high of the order block, or a rejection of the low of the order block, or a rejection of some kind of moving average inside of the order block. If you had a 200-day moving average, 250, 300 inside of a bullish order block, it's the best trade you can get. Remember, deep dip buys off the 200, 250, 300 by themselves are legit. But if that 200, 250, 300 is living inside a bullish order block, it's even better. So why did I take the trade on Friday? I took the trade on Friday because we rejected the bottom of the order block. The day before, it rejected the bottom of the order block as well. I just didn't see it. And by the way, it also rejected the negative third Keltner channel or ATR channel the previous day. So and a V1, if you want to throw that on top too. So I just didn't see the trade on this day, but I did see it here on Friday, so it's almost exactly the same. So I entered, I position sized, I placed my emergency stop 2 ATRs below. My end of bar stop is where? Just simply a close below this green box. You see how close it is anyway? Place my 1.5 ATR trailing stop level above, and it's basically break even. Right, I just barely bought it. But so this is a brand new trade. This is how I set it up. Rejection of the bottom of the order block. I like to call these order blocks smart money areas, because if you look in the past here, when things were bearish and it was down, if you look into the future, can you say with confidence that the smart money was buying here? Yeah, you sure can, right? In hindsight, yes, for sure, right? So now we're back down into the area where the first smart money was buying. Is it smart money again? Maybe. Probably more times than not it is. And that's why I took the trade. And it gives me a very good risk-to-reward ratio. So we'll see. Monday, if it closes below the order block, simply out of the trade. That's it. But if it moves up, I'll take partial profits. If it gets a trailing stop mode, I'll go in trailing stop mode, and so forth and so on. So this trade basically break even. Okay, I exited two really big positions here, and I will explain why. Alibaba. All right, I took Alibaba here on the 14th of July. Why? Confluence of signal. First, we had a close under, close over the 200-day moving average. That's the black line, deep dip buy. Number two, we rejected the order block. You can see here is the green order block. On this particular day, the previous day, we were inside the order block, and then we closed above it. So that is a rejection of the high of the order block. So the confluence is close under, close over the 200, which is deep dip buy, and then we had a rejection of the high of the order block. So I entered 108.07. I placed my emergency stop, 2 ATRs below. My end of bar stop is simply a close below the 200, which is very close. Placed my 1.5 ATR trailing stop level above. And then the next day just took off like a rocket ship, where I hit multiple profit targets. I think I hit 6 profit targets on this day alone, and I got to trailing stop mode. So now I'm looking for a close below previous bar's low. Well, guess what? It never came. It never came. But I sold half here. Why? Well, on this day, we went above the 70 RSI during the day, and we closed below. One of my rules that I use and that I teach is, if you go above the 70 during the day, but at the end of the day you close below it, I sell half the position. And so that's exactly what I did. So I sold half on Thursday for a gain of 12.27%. Oh, yeah, that's right. I drew it to there. Okay, and then on Friday, I exited the rest of the trade. Why? Another rule, if I have a rejection of the 70 RSI, I sell half like I did. If I then, after that, have a close below a previous bar's low after rejecting the 70 RSI, that is my signal to get completely out of the trade, and that is what happened on Friday. We closed below a previous bar's low after rejecting the 70 RSI. Remember, on this bar, we rejected the 70 RSI. So if I reject the 70 RSI, then in the future, if I have a close below a previous bar's low, I am out. So I sold half for a gain of 12.27%, and I sold half for a gain of 9.91%. But really good example of confluence of signals. My favorite trade of all times is a deep dip buy that is inside of an order block. Well, this was it. Deep dip buy, close under, close over the 200, and then a rejection of the order block. So the two together, learn these. This will improve your trading dramatically and give you a lot of confidence in taking trades. And like I said, I teach private one-on-one lessons. I teach this in my 20-hour course, and I would love to teach you all the specifics. So great trade. Half, 12.27, half, 9.91%. And then Etsy. And Etsy, interestingly enough, it's kind of scrunched here. This is not a deep dip buy. This is not an order block. This is what is called a higher low V1 or V2. This one is particular V1 or V2. Again, I teach this in my course, but show you here this green line, the top green line and the bottom green line. This is the 1 ATR channel. This is the negative 1 ATR channel. Anywhere inside of the greens is called the value zone. So the first requirement for an Etsy trade is, one, you need to close below the negative 1 ATR channel of the green line, which we did all the way through here. Second requirement is you have to go into the value zone. Third requirement is you need a pullback, and then you need a V1 or a V2. A V2 consists of 3 bars, bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. That creates a V2 that happens in the value zone. So I got long 54.06. I placed my emergency stop 2 ATRs below. I know this chart's a little hard to see because it took off. But where's my stop on a V1 or V2? On the second bar, the washout bar, halfway of this bar. That's why I have this red line here. But I entered here and the red line's here. So you see how good my risk to reward is? If it had closed below halfway of this bar, I would simply be out of the trade. So I entered there. I placed my trailing stop there. The next day, takes off, hit multiple profit targets, and got to trailing stop level, move sideways, and then here is the first close below the previous bar's low after reaching trailing stop level. I got out for a gain on half for 3.26%, and then but I still have half, right? And so we keep moving up, multiple profit targets, profit target, multiple profit targets. So I'm selling into the strength. I got out of half the position on the 23rd. Why? Because we went above we closed above the 70 the day before, and then we closed below. So I take off half. Next day went up again strong, hit multiple profit targets, and then Friday was the first close below a previous bar's low after rejecting the 70 RSI. So I got out of the rest. So I got out of a quarter on Wednesday for a gain of 16.34%, and I got out of the balance on Friday for a gain of 13.4. So the first one, the quarter, 16.34%, and Friday the balance at 13.4. So higher low V1s, V2s. If you want to learn more about V1s, V2s in general, just go to my YouTube channel, and I have a video there explaining the differences. But yeah, higher low V1, V2 started off with a really good risk to reward ratio, and man, did that baby just work. But I am out of Etsy. So you can see, what have we used? We've used deep dip buys, we've used order blocks, we've used higher low V1s, V2s, and we have used abandoned babies. And so all sorts of different strategies, but you can see they've all worked both to the long side and to the short side. And again, this is what I teach. This is what I teach all my students, and I'm very happy to teach you all of these strategies step by step, rule by rule, And when you're done with it, I'm telling you, you're going to have a skill that you can use the rest of your life. So these are all the open and the open and closed on the daily. Let us go to the weeklies. I also take weekly trades. Weekly bars close on Friday, so I have to make my decision on Friday. Here is UUP. UUP on the weekly. UUP is the US dollar. I took this here on the 11th of July, at 27.21. Why did I take the trade? Confluence. You can see the green box. That means it's a bullish order block. And we have the 200-week moving average deep dip buy right in the middle. So the week that I took it for two reasons. First, the previous week we closed under. The week I took it, we closed over. By itself, deep dip buy, that's legitimate entry. Close under, close over. In addition to that, we also rejected the high of the bullish order block, right? The green. We were in it, then we closed back above it. That is a rejection. So that's where I entered my trade. I have placed my emergency stop 2 ATRs below, my trailing stop level 1.5 ATRs above. Last week was up. Can't remember if I hit a profit target or not. I think I did. So last week was up. This week pulled back a little bit. This trade is slightly down. I mean, just slightly by 2 pennies. Yeah, like 0.11%. But I'm still in the trade. Why? Because this week we still closed over this 200. If this week had closed under the 200, yeah, I would have gotten out because that 200 is my line in the sand. But again, the setup is the confluence of deep dip buy, rejection of the 200-day moving average, and order block. We were in it, and then we closed back above it. So we'll see. This trade looks really good to me. I like that this week we retested the 200 underneath us and closed back above. So it was kind of a retest. So we'll see what happens. We'll see what happens. But this one's slightly down 0.11%, but I like this trade. TLT. I've been in this trade for so long. I think I was 5 years old when I entered this trade. I bought this all the way back in January of 2025. Why? Well, you see the green box. The green box is a rejection of the order block. I entered 87.20. I placed my emergency stop 2 ATRs below. My end of bar stop closed below the low of the order block. I placed my 1.5 ATR trailing stop level above. And week after week, we kind of grinded higher. Went higher here, went higher here, hit a profit target, and then nothing burger here, nothing burger here. Nice big up bar here, where again, I'm taking off portions of my position, locking them in, reducing the position size. Here I get to trailing stop level, then we move sideways. And then this week here, nice big up week where I hit multiple profit targets. Again, I'm in trailing stop level. And then we had the big kaboom. It didn't take me out of the trade because it didn't close below the order block, but it certainly closed below the previous bar's low. The remaining shares I had there, I had to get out for a loss of, what does that say? 0.59%. So not a big loss, but again, I locked in profits on the way up, right? That's why it's important, in my opinion, to take partial profits when the market gives them to you. So next week was up a little bit. Next week was up nicely, actually, hit a profit target, and then we went straight down for a month. Didn't close below, so I stayed in the trade. And we've just kind of been sloppy, choppy, moving sideways, moving sideways, moving sideways. This week, I actually did hit a profit target. So this particular trade is slightly underwater, slightly, about 1.01%. But again, looking at this in context, I took multiple profit targets on the way up here. I got out of half here. And I have had 7 months of dividend as well in this trade because TLT pays about a 4% dividend and it pays it monthly as well. So all in all, I'm up on this trade, which is crazy, right? But look, every trade doesn't work out, and who knows, this trade's not over. So we'll see what happens. So that one's down 1.01%. And then last but not least on the current trades is Shopify. So I took Shopify here on the 18th of July. I shorted at 127.03. Why? Well, you hear me talk about bullish order blocks. There is also such thing as a bearish order block. What creates a bearish order block? Well, first of all, you need a swing high, followed by a swing low, followed by a higher swing high, and then you need to take out the swing low, which changes the market structure to the downside. Now that you are in a downside market structure, you can identify the bearish order block because it is the highest up bar close before market structure change. And here it is, the high and the low of the highest up bar close is the high and the low of the red box. When I took this trade on the 18th, why did I take it? Well, because it rejected the high of the order block. It went above it during the week and then closed back in. So that is my short. So I position size. I place my emergency stop 2 ATRs above as always. And then my end of bar stop is simply, because I'm short, a close above the high of the order block, which it did not do. So I'm still in the trade. Here's what's the orange line. That's my 1.5 ATRs below me because I am short. So this week was down 2.08%. So I guess that's about how much I am up on the trade here. Oh, I have it here as 2.31% on the short. So anyway, doing fine. And again, it's a short trade, so I want it to go down. Earnings are coming here on the 6th of August. So regardless of whether I'm in the money, out of the money, whatever, as long as I'm in the trade and I get to earnings, I will exit the trade regardless if I'm up or down on the trade because I do not hold through earnings. So anyway, this particular short up 2.31%. So it was a really good week trading, but you see both to the upside and to the downside using multiple different approaches: deep dip buy, order blocks, abandoned babies, and higher low V1s, V2s. It's important that you learn different strategies that you can use in different market conditions. That's what I do. That's what I teach. That's what I suggest people do, is look at different strategies so you have different tools in your tool belt. Okay, so those are all the positions, open and closed. I hope that was helpful for you. And before we get on to the trades that I'm looking for next week, let's talk a little bit about trader psychology, and then we'll get to the trades. Okay, this is from my good friend Steve Burns. It seems like every week I do trader psychology on something that Steve Burns posted, but he posts great stuff. And by the way, he has some really great new trading books out on Amazon. And go and check him out. Read all his books. You will learn a lot. I worked and studied with Steve for a couple years, and we're friends now. And he's a great guy, and he teaches and writes great trading books. So check out Steve Burns' book on Amazon, or you can follow him at Twitter, @JosephBurns on Twitter. But I remember when he posted this years and years ago, and so when I saw it online, I went, oh yeah, I want to talk about that. So 5 different trading rules. This basically covers them all. Number 1, trade to trade well, not to make money. Some people have a problem like, well, what do you mean? Don't you want to make money? Yes, you do. But the thing is, it is important, what I have found, if you focus on not losing money. So if you focus on risk, that is when you make money. If you focus on making money, that's when you lose money, ironically, right? Sometimes with my students, okay, let's talk about making money. No, let's talk about not losing money, and then the money will flow. So trade to trade well, process-driven trading. Like I said at the beginning of the podcast, get yourself a strategy, get yourself a process, whether it's from me or someone else, and then follow it. Your goal should be to trade that process perfectly, win or lose. But if it's a decent process over time, that's when you'll make money. So trade to trade well, not to make money. Number 2, fiercely protect capital. As traders, we should really just be called risk managers because our number one priority is the stewardship of the money that you have. You want to fiercely protect that capital. And if you fiercely protect that capital, again, that's where the money comes. Number 3, act immediately without hesitation on qualified setups. If you get a trade, take the trade. Don't overthink it. Don't try to talk yourself out of it. Don't try to rationalize it. Even if you've lost money on that particular trade in the past, if you get another legitimate signal, you can take the trade, but it has to be legitimate. So act immediately without hesitation on qualified setups. Number 4, only thing worse than being wrong is staying wrong. You're going to be wrong. You're going to be wrong a lot. But if you're wrong, get the hell out of there. It happens to all of us. Every trader in the world is wrong. But the difference going forward from trader to trader is whether that trader stays wrong or just gets out, knows they're wrong, and gets out. So only thing worse than being wrong, which is totally normal, is staying wrong. This is not normal. If you're wrong, your stop tells you to get out, then get out. Number 5, if confused, see Rule 2. What's Rule 2? Fiercely protect your capital. So trade to trade well, not to make money. Number 2, fiercely protect capital. Number 3, act immediately without hesitation on qualified setups. Number 4, only thing worse than being wrong is staying wrong. And number 5, if confused, see Rule 2, which is fiercely protect capital. There is a lot of wisdom in this little hand-scribbled note with 5 rules. But if every trader just follow these 5 rules, make a huge amount of difference in their trading. So, okay, hope you found that helpful. And let's head over and take a look at the potential trades for next week. Now, here on the dailies, I have, looks like 7 potential entries. Now, theoretically, Monday, all 7 of these could trigger. So does that mean I would take all 7 positions, initiate a position in 7 positions? No. I only take 1 trade per day, even if I have 7 or 10 or 20 different candidates that are qualified. I have to narrow it down to the best one. How do I do that? Well, I take into account how many entry signals do I have, right? What's the risk to reward ratio? How does it look on a higher time frame? What's the relative strength of that market? Like, I give a quality score to each particular setup, legitimate setup, so that, let's just say one trade it rejected the 200. Okay, that's legitimate. But a second trade rejected the 200 and the 30. Oh, well, that's legitimate, but it has 2, so it's better. And maybe a third, it rejects the 200, it rejects the order block, and it rejects the 30 RSI level. Okay, that's 3. So which one do you think I'm going to take? I'm going to take the one that has the best quality setup, right? The best report card. And this is how I do my trading. This is what I teach to all of my students. The devil's in the detail, everybody. And so again, if you take the course with me, this is what I will teach you. So again, I'd love to have you a student. I am certain I will improve your trading. I've done it for hundreds of people around the globe, and I do it every week. And so again, if you're interested, please send me an email. Love to have you as a student. And if you're not able to do the 20-hour course as a start, I also have a really good online course at udemy.com, but it's just on deep dip buys. It's not on all the different approaches that I use. It's just deep dip buy. But that's a really good place to start at udemy.com, and the link to that is in the description. All right. So, okay, let's start here with India. And as a matter of fact, what I was just talking about, this is a perfect example. This was a legitimate entry on Friday. Why? This is INDA, by the way. Well, the green box here is the order block. Why is it an order block? Because over here, we have a swing low, then we have a swing high, then we have a lower swing low, then we change market structure. As soon as it changes market structure, I look for the lowest bar close before market structure change. Here it is, the high and the low. Going forward, I don't chase it up here, but if it comes down to here, then I take the trade. Okay, so this happened on Friday. Greg, why didn't you take the trade? It rejected the bottom of the order block. It did. But what did I take instead? I took Netflix instead. Why? Because it also rejected the bottom of the order block, but the previous day had a V1 and it rejected the negative third ATR channel. This trade that I took on Friday has a better quality score than INDA. Does that make sense why I took that one? I could have taken this one, completely legitimate, but it didn't have as high of a quality score as Netflix, and that's why I didn't take it. So going forward, can I get into this trade? I just want to see what it does. Look, here's the 250-day moving average, the purple line above it. If it goes up on Monday, for example, and closes above that 200-day moving average, then it's done two things. It's rejected the 200-day moving average, and maybe it's rejected the top of the order block. Then I could take the trade there, and then I would use the 200-day that would be below me now as support as my end of bar stop. Or maybe Monday it goes down, it gaps down, reverses up, gives me another rejection of the bottom of the order block plus a V1, something like that. But, who knows if that's going to happen. But the easiest way, what I'm really looking for, the easiest way to put this is there's a 250-day moving average above us. If it closes above that 250, then I have the support below me. So for the purposes of this podcast here, that's what I'll just go with. I'm looking for a close over the 250-day moving average, which at the same time would probably give us a rejection of the high of the order block. So that's what I'm looking for there. But would have been a legitimate entry anyway here on Friday. But again, Netflix was higher. Intel. Okay, Intel had earnings. That's why you see this big, huge down. This is a good example of why you should not hold through earnings. Sometimes it will be the opposite and it will be way up. But holding through earnings is really just gambling. And I have a friend of mine, have a student of mine that was in this trade, did well on the trade. And I said, make sure you get out before earnings. And I'm glad he got out before earnings because that would not have been fun. So going forward, what am I looking for in Intel? Well, we are coming back down to this long-term order block here. I've taken many trades out of this order block because if you go back in time, every time we've come into this order block, bounce, 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 bounce. So now we are coming back down into this, potentially, we're not there yet, into the order block. So what am I looking for? Am I looking for a high, a rejection of the high of that order block? Not really, because this order block is so wide. What I'm really looking for, the only thing I'm looking for on Intel is a deep dip buy under 30, over 30. Right now we're at 37.39. So that just means in the future, next week, if it continues down and goes under 30, over 30, it will be inside this order block. And in any deep dip buy that lives inside of an order block, I very likely will take. So we're at 37.39. We're above the order block, but just logically, if we do get to a 30 RSI, it will be somewhere in the order block. A rejection of the 30 RSI by itself, legitimate, but much better if it coincides with an order block. So I'm looking for a rejection of the 30 RSI next week of Intel in the order block. Coca-Cola, KO. Okay, this one's pretty easy. We have this big, wide green order block in the green here. And again, I love when major moving averages are inside the order block. Well, here's your major moving averages. 250 purple, 200 black, 300 orange. I am just simply waiting for the price to come inside the order block and reject either the 250, the 200, or the 300. And if it does, depending on the risk to reward ratio, I will take the trade and just use that major moving average as my line in the sand. But we're not there yet. You can see we got to the top of the order block. Every time we get to the top, we bounce, we bounce. Last 4 days, the market has not wanted to sell anything lower in this order block. So I don't know if this is going to happen, may not. But if it does, I know what I'm looking for. Rejection of the 250, rejection of the 200, or rejection of the 300 on Coca-Cola in the order block. Southwest Airlines. Another big, huge down bar because of earnings. Imagine if you gambled on earnings right here. Boom, not good. But what I like about this, it's a reasonable entry position here on Southwest Airlines, which is love. You can see we have a green order block. Why the order block? Swing low, swing high, lower swing low, market structure change. Looking back here, was smart money buying here? Well, yeah, when you go into the future and it's up here clearly, when it's up here, smart money was buying here. Well, I'm waiting for the price to come back down to where that original smart money was. And this is a perfect setup. It's not there yet. I don't know if it will get there, but if it gets there, I will certainly consider taking the trade because it's such a strong setup. We have the 200-day moving average, major moving average, that lives inside the order block. So next week, if we come down further, reject the 200, that would be my entry, and I'd use that 200 as my line in the sand. Philip Morris. I remember on the podcast I was talking about shorting Philip Morris because we had a bearish order block here. I didn't take the trade, but I'll just show you. Swing high, swing low, higher swing high, market structure change. Market structure change to the downside. You want to short when you get back up in the bearish order block. There you go. I didn't take the trade. Look what happened. Amazing. But now, going forward, and this is unlikely that it's going to get here this week. I mean, really, it's unlikely, but it's certainly possible. We have an order block back here from January, February, March, April. April 8th all the way back here. We have now run that into the future. Anywhere in this green box would be the supportive area to buy. And what's living inside that green box? 200-day moving average. So this would be a confluence of a deep dip buy along with the order block. So that's what I'm looking for. I'm not dying to get into Philip Morris, but if it does come down, bounce, intraday rejection, or close under, close over that 200-day moving average, that's the key area that I'm looking for. Again, I don't know if it's going to get there. If it doesn't get there, I'm not going to touch the trade. But in a perfect world, if I look at this chart and go, okay, Greg, what would be the perfect place to buy this? I'd say, oh, clearly rejection of that 200-day moving average inside the order block. So if it happens, I will definitely consider taking the trade. Tesla. I've got Tesla both on the daily and the weekly at this moment, everybody. But so Tesla did not have great earnings, gap down. But look, we have a nice bullish order block here. Why? Swing low, followed by a swing high, followed by a lower swing low, followed by market structure change, defining this bar here, the high and the low of this bar here as the order block into the future. I'm not going to consider buying Tesla until we either reject the high of this order block, reject the 100-day moving average inside the order block, or reject the bottom of the order block. Now, if we came down and rejected the high of the order block, I might take that trade, but I would not use the bottom of the order block as my stop. I would use that 100-day, the red line, as my stop, as my line in the sand. But we'll see what happens. But this is the interesting area to buy, somewhere between 296 and 288. But ideally, what would I like to happen? It come into the order block, reject that 100-day moving average, and I could use that as my line in the sand. Natural gas. Well, had some good trades on natural gas, and now we are coming right back down to the order block, all the way back from 12/3 of 24, everybody. Swing low, swing high, lower swing low, market structure change. Run that out into the future, and that is almost where we are. And it's a very narrow order block. So because it's narrow, the risk to reward is better. And so I am simply waiting for rejection of the high of the order block. You can see here on the 23rd, it almost did it on that day. We're at a 35.72 RSI. So we're from an RSI perspective, we're getting okay, I should say this. If we come into the order block, then we will be in the low 30 RSIs. So we could have an under 30, over 30 inside the order block, completely legit. So three options: rejection of the high of the order block, rejection of the 30 RSI in the order block, or a rejection of the bottom of the order block. And all we can do, if this happens, all I can do is take the trade, have a good risk to reward. If I'm wrong, I'll probably be wrong small. If I'm right, I can have a nice swing back up, maybe all the way to the 200-day moving average. So I hope that helps on UNG. And now let's switch to the weekly charts and see what's cooking on the weeklies. Again, weeklies close on Friday, so I'd have to make this decision next Friday. Here's Adobe. I've been watching Adobe for quite a few weeks. We have a bullish order block here. Again, why? Swing low, swing high, lower swing low, market structure change, defining the lowest bar close before market structure change as the high and the low of the order block. And you can see 2 weeks ago, we did reject the high of the order block. I didn't want to take this trade because I felt like it was too wide of an order block. What I'm really keying in on is this 353 level inside the order block. Why this level? Because if you come back over here to the April 25th, we have a big up bar. If you have a big up bar from a Fibonacci standpoint, a 50% retracement to the middle of that bar, you will find inherent support. Well, that's where the inherent support is. And that inherent support lives inside the bullish order block. So essentially next week, really the only way I'll consider taking this trade is next week if we come into the order block, reject that 353 level. Here, I'll give you an example. If this week it would have done this, I would have taken the trade. See how it rejected halfway? Where would my stop be? Well, of course, I put my 2 ATR emergency stop below, and my end of bar stop would simply be a close below that 353 because I want to keep that risk to reward ratio nice and tight. But we're not there yet. I don't know if we will, but for the purposes of this channel and the trades, I'm looking for rejection of 353. DIA, which is the Dow Jones. All right, you see a red box. What does that mean? That means I am looking for a short. We have a bearish order block. Doesn't look bearish, right? But from an order block perspective, it is, because the high and the low of this bar here on 11/29/2024 was the highest up bar close before market structure change. If you remember, I took this trade. I took this short here down to here. Well, now we're back there. So what am I looking for? I'm looking for a short. Where exactly am I looking for a short? At this point, I'm just looking for a rejection of the high of the order block, just like I showed you on Shopify. So the high is 451.28. I am just simply looking for a rejection of the high of 451.28 and a close back below. That would be my short. My stops, emergency stops, 2 ATRs above. My end of bar stop, simply a close above 451.28, just keeping it close, right? So we'll see. Maybe it doesn't ever get there and I don't take the trade. But I took this trade last time, exactly the same setup, and this happened. Will it happen this time? I have no idea. Might just go roaring up from here. Could be wrong, right? But all I can do is identify the trade, position size, get in the trade, keep my risk to reward ratio good, and the rest is up to the stock market gods, right? Lockheed Martin. All right, again, Lockheed Martin, another earnings casualty, right? Had earnings and it just crushed down. So there, really what I'm looking for here, I'll just take this one off because this is really about the only thing that I'm looking at here. And actually Friday, it was a legitimate entry because we had this lower order block in the blue. I better change that to green. I don't want everybody to go, what's the blue? I only understand green. Okay. That was a legitimate entry. Why? Because it rejected the 250-week moving average and it also rejected the top of the order block. So why didn't I take the trade? Just experience. The reason I didn't take the trade is because of this big skyscraper down bar. That's simply why I didn't take the trade. I would like to see the price stabilize a little bit, maybe give me a V1 or a V2 or something, or another retest of the 250 with a little better risk to reward ratio. When you have these big down bars like this, very often you will have a rally and you'll rally to about halfway of the big down bar. Half rally down, yeah, maybe you rally to about here before you head back down. So really at this point, I guess I should say two options. One, another retest of that 250-day moving average, but the perfect is here at the bottom of the order block. Why? Because you have the bottom of the order block and you see the orange line, the 300-day moving average, right there at the bottom. So that confluence is about perfect at 397.67. So yeah, and it makes sense, like round numbers. If you got near the $400 level, that would probably be the spot. So for the purposes of this channel and this podcast today, I am just going to say I am looking for a rejection of the 300-day moving average inside this bullish order block. Tesla, I talked about Tesla on the weekly, but we also have I talked about Tesla on the daily. We also have Tesla on the weekly. Why? Bullish order block. Swing low, swing high, lower swing low, market structure change, 200-day moving average inside of the bullish order block. That 200 kind of dovetails with about halfway of this big up bar. So this right in here is, in my opinion, about the sweet spot, somewhere between 261, 245. So it's significantly down there. Remember, I showed you on the daily, I'm looking for a rejection of this daily order block for starters. But if it mows through that to the downside, and I'm looking at the weekly, that's what I'm looking for. Ideally, in my perfect world, if the price got down to the 200-week moving average, again, which is about 255, it's perfect because it's inside a bullish weekly order block. It's a major moving average, and it's at halfway of the big up bar on 425. Let's go to oil, USO. Again, an order block below, we have beautiful long-term moving averages, 250, the purple, 300-day moving average, the orange, that live inside the bullish order block. We're substantially away from those. We're not close to those. So I'm not expecting to take this trade, but if something were to happen and they were to get down to those levels, that would be the key level. May not happen this week. It may be weeks from now. But if we get down to the 250-week moving average or the 300-week moving average inside this bullish order block, that would be the level that I would be interested in. VIX. So VIX has gotten crushed, which makes sense with the market being so high, but we are very, very, very close to the bottom of this weekly order block on VIX. The bottom of the order block goes all the way back to the 24th of January 2025, lowest bar close before market structure change. And the thing about VIX, everybody, nobody wants it until they want it. Look at this. Back here, it was 41.46. A couple months later, it was 92.89. It had doubled. This is what VIX does. VIX gets sold, and then it explodes. And we are getting down to that level. And if the VIX is getting down to this level where it should bounce, what do you think is going to happen to the market? Right? I like to look at VIX to tell me where I think the market, to give me some ideas and some insights on when the market's coming. So for me to get long VIX, I need it to reject the bottom of this order block and close back in. The bottom of this order block, 41.74. So it's not that far away. That's where I would take the trade. Last but not least, XLE. We have a bullish order block from the past here. We have a 200-week moving average at the bottom of the order block. So for me, not super excited about having to get into XLE. It doesn't mean I will, but I know exactly the level. The 200-week moving average at the bottom of the order block, that is the entry, and that looks like it's about 82, 83. So it's not too far away, and it gives a good risk to reward ratio. So that's what I have on the dailies and the weeklies, everybody. If you have any questions about those potential trades, please let them know. Please let me know if you have any questions about anything that I've discussed in the podcast. Happy to answer your questions. Get there and reply as fast as I can. I appreciate you being here. Like I said, if you would like to become my student, I will teach you everything I know. I've traded for over 30 years. I teach a 20-hour course where I teach you all of the different strategies. I will show you exactly how to use them. And we'll spend a lot of time together, 20 hours, right? But when you are done with that class, I promise you, you'll be a better trader. All you have to do is email me and we can start the discussion. Again, I have the online course available at udemy.com, the Deep Dip Buy. It's a great course. It's 9.5 hours of video. I teach you step by step how to trade the Deep Dip Buy approach. And it's very affordable. It's between, I think, $30 and $50. And I think I have 4.8, 4.9 stars on that video course from students all over the world. So if I can help you with anything, please let me know. Get yourself a process. Follow the process. Market's a little bubbly here, right, everybody? So make sure you have a process. Make sure you follow it. Please be careful. I hope you have a good rest of your week. I always like to leave off with, if you can, please try to go out and do something nice for someone today. If we all did something nice every day, it would make the world a better place. If you have it in your heart to try to go out and do something nice for an animal every day, they appreciate acts of kindness just like we do. And but I appreciate you being here, everybody, and God willing, I will see you next week. Have a really good rest of your weekend. And again, if you have any questions for the podcast, please let me know. All right. Thanks, everybody. And hopefully we'll see you next week. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.